So I have a real estate company with over 10,000 apartments, 300 plus employees. And over my career, I've found that the best deals always have the same thing in common. So the best real estate deals always have a great story in common. So let me give you the last two examples, but every deal we buy always has a great story that's easy for everyone to understand and makes it simple for people to invest in. So the first deal I'm going to talk about is just a 182 unit building that any of you probably had got into your inbox if you're in this game. So this is a senior community in a senior area. And the management and the ownership was really frustrated with each other because the property had 80% occupancy. They were spending a lot of money on marketing. The revenue was down, the expenses were up, and so they decided to sell it because they could never get above 80%. Now, the reason I like this deal is because it has a great story. Because if you really dug deeper, which you should be doing in any deal that you buy, you would see that all the first floor units were 100% occupied, and all the second floor units were 60% occupied. And this, from a common sense standpoint, makes a lot of sense because these seniors didn't like walking upstairs. That was it. And so if they had a choice, because all the units were priced the same, all the ground floor units were occupied and the upstairs were largely vacant. This severely impacted operations of anywhere from $20,000 to $30,000 a month. Having units 40% vacant when rents are $1,000 to $1,500 each equates to a lot of money each and every month. But they couldn't figure this out. So I decided to buy this property for the following reasons. I knew that from a common sense standpoint, that if I increased the prices of the first floor units by $75, they would now be priced differently. And then the seniors would, of course, start renting the cheaper units, which were upstairs. And this is a simple repricing. And so that happened, but it took about a year because everybody's on a 6 to 12 month lease. But over about a year's time, we were able to increase the first floor units by about $75, which equated to about $82,000 in annual revenue. The other thing that happened was because the second floor units were now higher occupied, we started to see an occupancy of close to 90%. So we were about 90% on the second floor and 100% on the first floor just by doing this simple pricing. But what that did is equated to almost a $400,000 swing in revenue. If you add an additional 30% of the 91 units, then they were paying about $1,000 to $1,500 each. You will see that this equates to about $350,000 to $400,000. So by just repricing this property and managing it a little better, we were able to reduce our marketing costs, reduce our turnover, and of course, increase the occupancy and the revenue, equated to about $350,000 to $400,000 more in NOI growth, which is simply revenue minus expenses. And what this did was this equated to about a $7 million increase in value. So if you take $350,000 and divide it by like a 5% cap rate, that's a $7 million value add. So the story of this entire project is we could buy this property for $10 million. We could increase it by repricing it and having better management, increase the revenue and reduce the expenses, like I just said. But all of that would equate to about a $7 million value add. So a $10 million property at the end of 2 years was going to be worth about $17 million. So this is the story, and this is how we raised the capital to buy this project. So the story, as you can see, is very simple for anyone to understand. And when you're raising capital or managing property, this is how you need to communicate, and this is how money is raised, whether it's in the form of debt or equity. Everybody wants a story like this that seems so obvious, but not everyone sees it. So if you want to see exactly what MC Companies does when it's looking for an apartment deal, you can download the link here. So now let me show you guys how you can do this on a much smaller scale, which is the next example. So this is years ago when I was a young man, but I remember how simple it was now, and I went on to do this later, and this is what we call a condominium conversion. Now, I did thousands of units in Tucson, in Vegas, in Scottsdale. I did this all over the country. So this model can be done anywhere, but on this example, it's just a fourplex. So this is your traditional fourplex. This is a 3-bedroom, 2-bath for 4 units that we're renting for about $1,500 a door. So that equates to about $6,000 in revenue each and every month if it's 100% occupied. Then you have all the expenses, and of course, you have a cash flow for whatever that fourplex is. So it's important to understand that this fourplex had one owner that collected 4 rents from 4 different people, and it was a rental play only. And then this property came up for sale for $450,000. If you're buying a fourplex and you're looking for passive income, you might have stayed with this model. But what I was trying to do was I was trying to convert it to condominiums. Now, this only works if condominiums are significantly more in value than it would be if you bought it as a rental property. So in this particular case, this property was for sale for $450,000. But the whole point of it was to turn this into a condo project. That's the entire point. As a condo, those same 3-bedroom, 2-bath units were selling in the market today for about $200,000 each. So before I even bought this property, I said, okay, I can buy it for $450,000, and if, and only if, I sell all 4 of these, I can sell them for about $800,000. This is your traditional condo conversion. Now, there is some work to take it from 1 owner to 4 owners, which is primarily legal. And this is a condo conversion process. And I did this over and over. I did it with boat slips. I did it with RV parks. I did it with commercial office. And I did it with apartments where you can buy 200, 300, 400 unit apartment buildings and sell them off piece by piece. This is a fourplex that's a full rental, turning it into a condo. But it only works if the condos are selling for significantly more than they would as an apartment building. And you see this a lot. You see a big difference between what a property would sell for as an apartment building per unit versus one right next door that's a condominium. Now, there's a lot of things that need to happen because homeowners are very different than renters. The first thing is to take this through the legal process, which could take 6 months or a year to do. But then you can list these things for sale. You have to set up an HOA and bylaws and all of those things that you have to do in order to get them converted to a condominium. But eventually you can sell these for $200,000 each. Mind you, nothing's changed. You're selling rental units as a condominium, that's all. But there's a legal process you have to go through in order to get to this point. So we did this all inside of 1 year. So we bought the property, converted it to a condo, and then at the end of 1 year, we had sold all 4 condos for about $200,000 each, and we made about $250,000. And the reason why it wasn't $350,000, which is $450 to $800, is because there was about $100,000 worth of legal work and commissions and things like that. So we netted about $250,000. So again, the story is, whether it's your money or somebody else's money, whether you need a partner or you have your own money, is this process is the story. I'm changing the use from a rental property to ownership. I'm going from 1 owner to 4 owners, and I'm selling them off rental units as condominiums. And a lot of these condominiums, ironically, were actually rented out by the people that bought them. This is a simple change of use real estate story. But the point is, anyone can do this. You guys have seen my billboard story. If you haven't seen that, just go click here. But it's when I bought a piece of real estate, all I wanted was the billboard, and I got the billboard for free, which now produces $30,000 to $40,000 a year. Who doesn't want that deal? Who doesn't want a deal? Again, a story that says, you want a free billboard that produces $30,000 or $40,000? Everybody's going to look at that deal. Every real estate investor and every person wants some kind of a story that's easy to comprehend. Whether it's a 182-unit building that's a senior project, or whether it's a 4-unit deal that you're converting to a condo, or whether it's just a billboard that's sitting on a vacant piece of land. They're all stories that make sense, and they're simple, and you can raise capital on them. And this is how you buy real estate, and this is how you do it simply for others to understand. So most people, when they're buying real estate, think it's a sales job. So they think the bigger the brochure, the better the deal. They actually stack it up with all these analytics and economics and paper and all the stuff, and they try to sell you on the fact of what it's going to be in the future. Those are the worst deals on the planet. What you want is something that's really simple. And then you can start to dissect all the little risks. What might happen if you can't get the legal? What happens if the market changes? What happens if the mortgage interest rates go up? Those are all risks that could happen in this 1 year. Now it's quantifiable. But what happens with a lot of people when they buy real estate is they jump in feet first and they don't have a story. Their only story is it's going to be worth more later. That's not forced equity. That's not what we're doing here. Each of these deals has forced equity. None of them are gambling. And that's what a lot of real estate investors do. They gamble. They say next year is going to be better than last year. That's gambling, and that's not the way you want to invest. As I said earlier, I got a free billboard that's now producing over $30,000 to $40,000 a year. If you want to see how I did that and how you can do that for yourself, you're going to want to watch that video here.